What's up, everybody? I want to get out some big information when it comes to divorce planning, tax planning, social security planning, all these three things and how they're interrelated, and the massive tax that you can pay if you make this one simple mistake when it comes to divorce planning. And I'm going to go over what that is. And if you know anybody that is going through divorce or contemplating divorce, obviously it's very hard. As we know, you've probably seen the statistics, over 50% of people that get married end up getting divorced. And even when people have lived their entire lives together, raising kids in their 50s and 60s, the divorce rate is still like 25%. And this is the scenario that I want to talk about today. And make sure you pass this along to anybody that's thinking about it. Or just make people aware of this. If there's any hard times going on with a marriage, this is very critical. So let's lay this out. This is a hypothetical client scenario that I want to go into. And I call this one Mr. and Mrs. Getting Ready to Retire. So client net worth, they're filing joint 66, getting ready to retire next year at 67. The husband's been kind of the breadwinner, but they're done working and want to retire, but they're literally been talking about getting a divorce. It's just not working out anymore. And their New Year's resolution is literally, they've determined they want to start the new year fresh, not married anymore. They want a new life, which is just sad. But that's the honest truth. Things happen like that. But when it comes to getting a divorce, whether you're middle of the year, getting towards the later of the year, there's a huge tax planning thing that if you're not talking to your accountant or CPA while you're thinking about or in the process of getting a divorce, and even your attorney, and they're not bringing this up, you need to bring this up to them, because this is huge and how you can save thousands of dollars with this very simple thing you need to do. All right, so let's talk about this. Over $1 million net worth. $20,000 in the bank. They got about $1,700 in credit card debt, $819,000 in investments. Most of that is in Mr.'s retirement plans. $131,000 loan. Property of about $300,000 is their home they currently live in right now. And that's the investment piece. And by the way, what I'm pulling up right now is the #1 ranked financial planning software in the country. If you want access to this, reach out to us. You can email us at william.wilkins@lpl.com. You can also text us 513-657-0989. I'd be glad to get you a complimentary discovery call to see how we might be able to help you out. But anyway, back to the scenario. Now, the true DNA of what's going on in somebody's life is their tax returns. Kind of like the blood work of a financial plan. Like you go to your physical, you get a blood work done. It tells you what's going on in the internal parts of your body. That's what a tax return can do. And you can find a lot of ways to save people money if you look at their tax returns, and also learn things like you're seeing here to save tons of money. All right, so let's take a look at this. One thing you can do up here is you go into this tax tab at the top, click on that. And then we're going to come down here and click on details to the far right. So literally this software will run simulated 1040s, not only for this year, but we can click one little button. It'll take you and look in the future too. You pick any year you want in retirement. I'll show you what your tax return might look like under current tax law. But let's take a look at the blood work. So current W-2 wages, $103,000, got dividends, interest, and they've been doing on line 2B, 3B, and then you got 4B here. $37,000 of Roth conversions because their accountant, or they read online, looked at another YouTube video and said, hey, we should be taking distributions from our retirement account. Pay at this lower 12% bracket. Don't go into the 22% bracket filing jointly and get hit with more taxes. So they've been taking money, but it's been coming out of Mr.'s retirement accounts, IRAs, and this is huge. So you got to watch this. They've also got $6,300 in capital gains from selling some stock. So their total income, $150,000 over here. That's your AGI as line 11. And AGI is huge when it comes to phase outs, knowing that income number. All these, especially the recent One Big Beautiful Bill Act, a lot of things are impacted. Auto loan interest deduction, your senior deduction if you're 65 or older, which you're going to see here how this gets impacted, is huge. So senior deduction or standard deduction plus all the new senior deduction, which is $6,000 per person when you're 65 or older. So joint, they're getting an extra $12,000 on top of the 31 plus standard deduction. Plus, as a 65-year-old, you also get an extra $1,600 each when you're married, $2,000 when you're single. So that's why we're coming up with this $46,000 and change. It's a little bit higher than that. It's like $46,750. The problem is they slightly went over this 150 AGI. And let's take a look what happens here. So they get a slight reduction in their standard deduction, not much, but total tax or taxable income is 104 after we subtract the 46 from the 150. So your total tax they're paying here, $12,286 filing joint. But remember what I said before, they want to be done with the marriage prior to year end. So their plan was to get this document signed right after Christmas, telling the kids, and they're done. Okay? So here's what's critical with this. They go ahead, they sign the documents, they get their divorce filed before year end. It's April 15th. All right? They're meeting with their CPA, they're turning in their documents. They file for an extension. And the CPA looks at them and they say, one of the questions, have you been married in 2025 or did you get a divorce in 2025? Oh yeah, we got a divorce at the end of the year. Oh, when did you sign your paper? Oh, December 27th. Oh, well, you can't file jointly. We're going to have to file each of you single. They're like, what? Filing joint. Because we were married almost the entire year except for 3 or 4 days. Got to file single. Why is that a big deal? Well, take a look at this. This is what's huge. So you go on here and you look at what we can do in the software. You go up to profile and you go under expenses and we can change this tax situation. Because right now it's married filing jointly here. You see that. We make one little drop down. We change it to non-married filing single on here. This is what is huge. I'm going to hit save. Got to make sure you hit save down here. And then we're going to go back to the tax tab, all right? Tax tab. We're going to click on details here. And then we're going to scroll up. And now you're going to see a little different setup on the tax return. If you look right here, this was not showing there before because they were married. But now, guess what? They have to each file single for 2025, even though they were married every day but 3 days in 2025. And here's the big deal with this. So now we look at, and this is Mr.'s tax return. So now he's got income of $83,000 on his piece of that 103 we saw before. He's got dividends and interest, 13 and some 976. And he's still got that Roth conversion, it's 37,000 he took out. That could be a problem. Let's watch this. You've got capital gains now, 3,800. So his taxable income is 126, no other adjustments. So his AGI filing single is 126. Why is that important? Well, when you're designated filing single at the end of the tax year, if you make over 75,000 AGI, that standard deduction, that extra 6,000 I was talking about, actually starts getting reduced. So you're seeing right here, it says 20,000 standard deduction. Well, it said 46 before. Well, no. They're filing single now. They're not joint. But you're like, well, that's not quite half of 47,000, 46, 47. That's what I just told you, because he's not getting his full 23,750 filing single because he's getting a reduction because he made too much money AGI filing single. So right there, you already have a penalty, okay, when it comes to divorce filing before the end of the year. His taxable income, 105, tentative tax, 1,786. He has no other deductions. And whammo, we've got $17,886 in tax versus $12,000. And that doesn't stop there, because if you're paying Medicare premiums, Part B and D for your physician and your drug plan, if you're making too much money there, they start looking back 2 years and see where your income was. You actually may have to pay an extra premium on top of the normal, say roughly 187, I think it is, in 2025, and 36 for a drug plan. So you get these penalties, you have to pay more. So that's another thing you got to look at with this. But now let's take a look at Mrs. So Mr.'s like, what the heck is this? So now he's paying an extra $5,000 in tax, which could have been avoided. I'm going to tell you how. And they could have split an extra $5,000, but now they can't. All right. So they got to pay 5 more in tax. So he's paying his part. But if you go to her part of the income is 20 grand, 1,700 or 1,100, roughly 800 in dividends, taxes or interest, and capital gains 37. Total income is 25,741. She gets a standard deduction of 23,750 because she's filing single, but she's under 75,000 AGI, so she does not get a reduction. And then her taxable income, 1,991. And if you know the tax brackets, that means she pays 0 in taxes. So she's banking on that. She's loving that 'cause she's not paying any tax, but Mr. the ex, he's got to fork out an extra $5,000. But that could have been an extra $5,000 they could have split. All right. And the main reason you want to take this to your CPA and attorney, it's right here on irs.gov. So you go to irs.gov under divorce and separation. If you are legally separated or divorced at the end of the year, you must file as single for that tax year unless you are eligible to file as head of household, which means you have to be taking care of somebody, and they're not taking care of anybody anymore, or you remarried by the end of the year. Most likely that's not going to be the case. So in this case, this is why they have to file single. And then this is huge for the spouse that wasn't making as much money. Okay. So they're going to be starting their Social Security next year, right? Age 67. He's getting $3,000 estimated in Social Security, and she was going to get 1,000 based on her earnings record. He's getting 3. So that's a total of 4,000. Well, normally the spouse that's made less is entitled to 50% of the higher earning spouse's income as a spousal benefit. So if the husband's making 3,000, she's only making 1, technically she would get a spousal benefit of $500 to bring it up to $1,500, which is half of his. But when you get a divorce, you have to wait 2 years, as long as you've been married at least 10 years, that your ex-spouse is 62, and he doesn't have to be taking Social Security, because he may delay it till 70, but as long as he's eligible for Social Security at 62, and you're over 62 as that lower earning spouse, you can then file for the spousal benefit, okay? And since we're filing at full retirement age, she would get the full 50% amount of his if it's higher than hers. So, but if she had more, let's say she had $2,000 Social Security benefit, she couldn't get a spousal benefit. It's only if you're making less, your Social Security benefit is half of what your higher earning spouse was. So not only is the penalty of the taxes on him, but now she has to wait 2 years. That's the requirement. 2 years when you get divorced before you can start collecting on your husband's higher Social Security benefit to get at least half of it. So that's 12 grants. So now we're talking about literally, because of the one with the taxes, not waiting till January 2nd, let's say the first business day of the year, if it happened to be that for 26, filing the actual divorce papers then, like signing them, official divorce, they could have filed joint the whole entire year. So the moral of this story is, if you know anybody that's thinking about getting a divorce or is in a divorce process right now, have them put the brakes on, look at this video, get a hold of their CPA, accountant's attorney, and talk about this. Because it doesn't matter whether it's quarter of the way through the year, halfway, if they're going to make all this income in 2025 or whatever, in the future year, 2026, if they can just find one last agreement they can have together to go out on a good note and start off this New Year's resolution on the right foot, they can wait to January 2nd. I think it's the first business day of the year, maybe even the first. But talk to an attorney about this, CPA, and even share this. Share this out to church groups or counseling groups where people are maybe looking to get married. Let them know these financial planning things can be huge, because literally our daughter and our son-in-law, they've had some friends that have gotten married and literally within a year or two have gotten a divorce. And if they didn't know about this, that could be a big hit if they're two big earners. They've been out of college and they're making some big money these days. That could be a huge deal for them on this situation. So Appreciate you watching. Till the next one, have a good one. Thank you.